His notes are absolutely definitive on the details of the equity market, the correlations, and particularly what flows of money are doing. Binky Chadha, thrilled to have you with us. I read and reread your paragraph on something I lecture about, which is positioning is everything. Tell me the positioning or lack thereof of this bull market run.
So what I would say, Tom, is that the story of basically the huge bounce that we've had since March the 23rd in the S&P 500 is really a positioning story. So what we had is a very, very unusual shock in the sense that it reached us all basically in terms of the news at the same time. So you have a very synchronized negative impact. The market, as you know, at the time was max overweight across basically every spectrum of equity investors. And so we all got the news at the same time, clearly very negative shock. So everyone went basically max negative. And since then, it's been largely basically a story of what I would call, a really classic short squeeze. I think the actors relative to, the historical textbook that you may have been lecturing about is a little bit different. I think systematic strategies are much more important. And so, if we fast forward the tape basically to this week as earnings begin, I would basically say, the squeeze is basically on again.
Right.
I think that there is a fundamental catalyst for that, and that is, we think earnings are basically set up to beat, and I can talk about that, but in the context of underweight positioning, especially in the cyclicals, as we go to reporting the banks, squeeze is basically continuing.
How has your world changed by such substantial negative real rates? How does your equity world change given what fixed income has given you?
I would say that low rates, especially negative rates, are really bad in terms of, made life very, very difficult for active equity fund managers. And that is because, rates are clearly a factor. I mean, if you think about equities, you can take sector, you can take the market, you can sort of line them up on one side as bond-like and at the other end as most equity-like. So rates matter. And when rates are far away relative to sort of, the economic recovery or the cycle, that is basically going to cause some major issues and, has basically caused major issues. So I would argue low rates are negative for the cyclical trade, is the bottom line. And so we really do need rates to start going up to have the cyclicals perform. And, as and when the recovery happens, you would expect the cyclicals to perform. But if rates don't go up or are artificially compressed, that's not going to be very easy.
I want to be clear, Binky, then about your view, this idea that positioning favors U.S. equities to go higher. And yet, unless real yields go up, it's not going to be favorable for cyclicals. Are you saying that the technicals are favorable for big tech right now, even though I'm not sure who's shorting them? I mean, is somebody actually out there aggressively shorting Amazon and Apple and Facebook right now?
No, I wouldn't say that. What I would basically say is that, I was speaking about positioning basically at the S&P 500 at the index level. One of the things that we emphasize is that there's really been sort of a tale of two equity markets. We have the mega cap growth stocks on the one side, the 10 stocks, and they basically, fell by less and have basically been trending up, and they are well basically now above where we were at the peak prior to the breakout of the pandemic. Everybody else is, way lower. So positioning at the index level, I would differentiate from, within the equity market. I would argue, basically that where everybody is underweight is everywhere else. And, our call is basically that, it's nothing wrong with the mega cap growth stocks and tech. We just argue that it's basically run very far, but they do grow much faster. So you don't really want to be underweight. You want to be neutral, but you really want to overweight the cyclicals. I would argue, tactically, especially for the next 2 to 3 weeks, absolutely. I would argue earnings, especially for the cyclicals, are set up for a beat. If you take a look at the bottom-up consensus, as we all know, fell massively as the shock hit in March and April. But basically by mid-May, the bottom-up consensus had stopped falling, so the downgrades had stopped. And history would tell you that basically once downgrades stop, depending on what happens to the macro data, you're going to get upgrades or downgrades.
Yeah.
And what we got basically is massive positive surprises on the macro data, but we also got, and so the consensus would have started to move up basically with a lag, but what we also got is the resurgence of the virus. So those upgrades basically never happened. And if you think about the resurgence of the virus in terms of the timing, it was really later, and the economic impact was later. If you look at our, macro activity pulse index, so you look at at Citigroup's CZ, you will see that the data surprises have basically gone to a place they've never been before. I mean, they're running at twice any kind of prior peak, and that should have basically seen upgrades. We didn't get those. So there's a lot of moving parts, but on net, I would basically say that, the earnings season is likely to beat. Positioning, especially in the cyclicals, is very low, and the combination of those, explains why the cyclicals and the financials were doing very well on Friday, and why the pressure on the market is basically to move up. But there is still a fair number of unknowns, and so it should be, I'm not saying it's clear and straightforward, but
it never is,
the bias is still up.
Let's build on that, shall we? The allocation to cyclicals. I've had many people come on this program, and others as well, say you want to maintain that allocation to US growth, but if you want to take cyclical risk, take a levered play and take that play through Europe. What's your response to that, Binky?
It's very simple and very short. It's absolutely, I would be overweight Europe, I would be overweight Japan. And that's really the same call as basically being overweight the cyclicals in the US. If you take the U.S. equity market and divide it into the mega cap growth stocks and everybody else, so I'll just call them ex-MCG if you want, you basically see that they bounced from the bottom, but they've essentially gone sideways, for the last few months. If you then overlay the other regional equity markets, you'll see that they're all clustered basically around ex-MCG. So I think for the U.S., it's very important to divide up the two in terms of thinking about sector or stock calls. If the growth happens, and clearly it's not going to happen in a straight line, but we've had a pretty big bounce, and what I'm saying is in the data so far, and what I'm saying is that that's just really not priced in.
Binky, I'm struggling to find people who aren't overweight Europe right now. How vulnerable is that call, at least from your perspective, on a fiscal hiccup this coming weekend?
I think, relatively modestly so. I think if you look at European performance and relative to the U.S., and especially if you do it, ex-MCG, you're going to see that, the two are basically moving together. And Europe actually, exhibits a sort of more resilience. And on the policy front, I think that it's important to think about the fact that, if it doesn't happen now, it will happen later. If we don't get it all, we will get some. I mean, and it's always a slightly mushy picture, so I wouldn't dismiss it. So, yes, there can be a negative outcome, but the negative outcome, can change too. So it's not a definitive negative. It's very unlikely.